Select a strategy for your first investments based on how much you want to invest, when you want to reach your goals, and how much risk you can tolerate. One of the best strategies to get good returns on your investment is to invest. Your financial status, your investing goal, and the deadline for achieving it will all determine how much you should invest. Depending on your objective, open a tax-advantaged account like an IRA or a taxable brokerage account. Select an investment plan that fits your time horizon, amount invested, and saving objectives. Recognize the stocks, bonds, and funds that you can invest in to create a portfolio that will help you achieve your objectives. When you first start out, rent, utilities, debt payments, and groceries may seem like all you can afford. This is especially true in inflationary times when your money doesn't go as far towards buying a house, a car, or bread. However, it's time to start investing when you've worked up a budget for those monthly costs and put some money aside in an emergency fund. Determining what to invest in and how much is the difficult part. You will have many questions as a novice to the world of investing, not the least of which are, how much money do I need? How do I start? What are the best investment techniques for novices? These and other queries will be addressed in our video. If you're new to our channel, then do subscribe to us for more. To begin investing this year, follow these 5 steps. Number 1. Make an investment as soon as you can. One of the best ways to see good returns on your money is to invest when you're young. Compound profits are responsible for this, since your investment returns begin to generate returns of their own. With compounding, the money in your account might increase over time. In addition, a lot of people ponder whether they can start with a small amount of money. To put it succinctly, absolutely. Thanks to fractional shares, low or non-existent investment minimums, and zero costs, investing with smaller sums of money is now more feasible than ever. Many investing options, including mutual funds, exchange-traded funds, and index funds, are accessible for comparatively small sums of money. Instead of worrying about whether your contribution is sufficient, concentrate on what feels reasonable in light of your objectives and financial status. Make a consistent contribution to your investments, no matter how small, whether it's $50 or $5,000 a month. Advises Brent Weiss, a co-founder of Facet, a financial planning company located in St. Petersburg, Florida, and a certified financial planner. Practical use of that. Assume you invest $200 monthly for 10 years and receive an average annual return of 6%. By the time the 10 years are up, you will have $33,000. Of that sum, $9,100 is interest you have received on your investment and $24,000 is money you have given, those $200 monthly contributions. Of doubt, there will be ups and downs in the stock market. But if you buy early, you'll have decades to weather the storm and see your money grow. If you have to start small, start now. Use our inflation calculator to discover how non-investing might cause inflation to eat away at your money if you're still not convinced about the benefits of investing. Number 2. Choose the amount to put in. Your financial status, your investing goal, and the deadline for achieving it will all determine how much you should invest. Retirement is one popular investing objective. Generally speaking, you should try to save between 10% and 15% of your annual salary for retirement. Although it may seem unachievable at this point, you can gradually increase it by starting small. Use our retirement calculator to determine a more precise retirement goal. Your first investing milestone is simple if your employer allows matching contributions for retirement accounts like 400 and Onyx. Contribute at least enough to the account to receive the full match. You shouldn't pass up that free money, especially when your employer match contributes to that total. For other financial objectives, like buying a house, going on a trip, or funding your schooling, figure out how much you need to invest each month or every week based on your time horizon. Number 3. Create a financial account. You can save for retirement in an individual retirement account, IRA, such as a standard or Roth IRA. If you're one of the many people who don't have access to an employer-sponsored retirement plan, like a 401k, retirement accounts, which are intended to be used for retirement and contain limitations on when and how you can withdraw your money, are probably something you should stay away from if you're investing for another purpose. Consider a taxable brokerage account instead, which allows you to withdraw money at any moment without incurring additional fees or taxes. If an individual has reached their maximum IRA retirement contribution and still wants to invest, brokerage accounts are an excellent choice because IRA contribution restrictions are often far lower than those of employers-sponsored retirement plans. Number 4. Select a financial plan. Your time horizon, your savings goals, and the amount of money you need to attain them will all influence your investment plan. Almost all of your money can be invested in equities if your savings objective, such as retirement, is more than 20 years away. For most people, however, investing in stocks is best done through low-cost stock mutual funds, index funds, or exchange-traded funds, ETFs. This is because selecting individual stocks can be difficult and time-consuming. Because of the danger involved with stocks, if you're saving for a short-term goal and need the money in less than 5 years, it's best to keep your money safe in an online savings account, cash management account, or low-risk investment portfolio. Here, we list the top choices for immediate savings. If you are unable or unwilling to make a decision, you have the option to open an investment account, including an IRA, with a robo-advisor. A robo-advisor is an investment management firm that creates and manages your investment portfolio using computer algorithms. Low-cost index funds and ETFs make up the majority of the portfolios constructed by robo-advisors. Robots allow you to get started quickly because they offer minimal expenses and little or no minimum requirements. For portfolio management, they charge a nominal fee that is typically equal to 0.25% of your account amount. Number 5. Recognize the possibilities you have for investments. You must select what to invest in after determining how to invest. There is risk associated with every investment, so it's critical to comprehend each one, its level of risk, and whether or not it fits with your objectives. The most well-liked investments for novices are as follows. Stocks. A stock represents a portion of ownership in a single business. Another name for stocks is equities. Depending on the company, stocks can be bought for a share price that is in the single digits or several $1,000s. As we'll explain here, we advise buying stocks through mutual funds. Bonds. A bond is somewhat like a loan that you make to a government agency or business, and they promise to pay it back to you after a set amount of years. You receive interest in the interim. Because you know exactly when you'll be paid back and how much you'll earn, bonds are typically less risky than stocks. Bonds, however, have a lower long-term return and therefore only constitute a tiny portion of an investment portfolio with a lengthy duration. Mutual investment vehicles. A collection of investments bundled together is called a mutual fund. Investing in mutual funds enables investors to buy a diversified collection in a single transaction, saving time and effort compared to selecting individual stocks and bonds. Generally speaking, mutual funds are less hazardous than individual equities because of their inherent diversity. While index funds, a particular kind of mutual fund, track the performance of a particular stock market index, such as the S&P 500. Other mutual funds are professionally managed. Index funds are able to charge cheaper fees than actively managed mutual funds because they do not require expert management. A minimum investment of $1,000 or more may be required for some mutual or index funds. Mutual funds that are exchanged on an exchange. An ETF is a collection of numerous individual investments, much like a mutual fund. The distinction is that ETFs are bought for a share price and trade all day long, just like stocks. Because an ETF's share price is typically less than a mutual fund's minimum investment requirement, it's a great choice for novice investors or those with limited resources. Share your opinions with us in the comments section. Don't forget to like and subscribe to our channel. Thanks for watching.